Have you ever seen a company report a fantastic quarter only to watch its stock get absolutely hammered? Well, that's exactly what just went down with Broadcom. And in the next few minutes, we're going to break down precisely why it happened. So let's just get right to the heart of the mystery. Broadcom delivered what we call a beat and raise, the kind of report that should send a stock soaring. Instead, it just cratered. So what on earth did the market see that the headlines completely missed? Okay, first, let's just look at the numbers, the headline results, because on the surface, they should have had investors popping champagne. They were, frankly, incredible. For Q4, Broadcom's revenue clocked in at over $18 billion. And we're not talking about a small beat here. That's over $500 million more than anyone was expecting. A huge, huge win on the top line. And it wasn't just revenue. The profitability story looked just as good. Adjusted earnings per share hit $1.95, easily clearing the $1.87 Wall Street was looking for. So far, so good, right? A perfect report. And then, this happened. The very next trading day, the stock just plunged over 11%, a move that wiped out billions in market value and left everybody scratching their heads looking at those great numbers. And this wasn't some quiet little sell-off. Trading volume absolutely exploded to nearly 4 times its daily average. When you see volume like that, it tells you one thing. The big, institutional players weren't just a little worried. They were actively and aggressively dumping the stock. Okay, so to figure this out, we have to listen to the story that management was telling on their earnings call. And that story was all about one thing. A single, incredibly powerful narrative, the absolute dominance of their artificial intelligence business. First, just get a load of this number, a $73 billion backlog for their AI components. Now, that's not some pie-in-the-sky projection, that is booked business. It means Broadcom has a massive chunk of its revenue already locked and loaded for the next year and a half. And then the CEO, Hawke-Ton, basically put an exclamation point on it. He didn't use vague language about growth. He gave a hard number. He's guiding for first quarter AI revenue to literally double year over year. I mean, that is just extreme confidence. And this chart really tells you everything you need to know about how critical AI is right now. You look at their core semiconductor business, AI revenue was up an explosive 74%. Everything else, barely moving, up just 2%. Right now, AI isn't just part of the growth story for Broadcom. It is the only story. And this isn't just talk, right? It's backed by tangible, massive deals. Management called out a fresh $11 billion order from AI leader Anthropic. They signed a brand new billion-dollar custom chip client, and they're seeing record demand for their high-end AI networking gear. This engine is absolutely redlining. So with all of that unbelievable AI growth, why in the world did the stock see a historic sell-off? Well, it all came down to one small but incredibly crucial detail buried in the guidance that completely overshadowed everything else. So to get what happened, we need to quickly touch on something called product mix. It's actually pretty simple. Think of it like a restaurant. If you sell a ton of cheap appetizers, your total sales for the night might go way up, but your overall profit margin is going to get crushed compared to selling expensive steaks. The exact same principle applies here. And here's the number. This is what sent Wall Street running for the exits. Management guided that this big shift, selling more and more of their custom AI chips, would actually lower the company's overall gross margins by about 1 percentage point, or 100 basis points. So this is the fundamental conflict that was raging in the market's mind. You've got the bull case on one side, this unstoppable AI revenue machine with a $73 billion backlog. But then you've got the bear case. Those same blockbuster AI products are actually less profitable, and they're dragging down the company's overall margin profile. And on that day, the market decided the bear case was the one that mattered more. All right, so after all that drama, where do we go from here? Let's break down what we're watching for and give you our official rating on the stock after this pretty dramatic reset. Looking ahead, there are really 3 big questions we need answers to. Number 1, can Broadcom find efficiencies somewhere else in the business to make up for those lower AI margins? 2, can they actually execute and deliver on that massive $73 billion backlog without any issues? And 3, can their big new software business, VMware, act as a stable foundation if the other parts of the hardware business stay weak? So here's our take. Despite the market's panic over margins, we think the reaction was a major overcorrection. The sheer scale and the speed of the AI business, which is confirmed by that giant backlog, is a force that's just too powerful to ignore. Yes, the margin percentage is coming down a bit, but the absolute dollar value growth and profit is going to be immense. For that reason, our rating is outperform. This is not financial advice.